And thank you to all those listening for taking time out to allow us to take you through this pension issues for high earners. We expect the presentation to last for around 45 minutes, then allowing us 15 minutes for questions. As Athena said, if we don't get round to your question, we will pick that up offline so you get an answer to that. The two presenters are myself, Toby Alcock, and my colleague Andy James. So what are we going to discuss? Well, I'll give you a very brief introduction to Towry, which is the company that both Andy and I work for, so you have some background as to our experience and knowledge in this area. Then the main topic, we're going to look at the forthcoming pension changes, in particular the lifetime allowance and the annual allowance, and then we're going to have a look at ways in which potentially some of these issues can be met by some of the tools that are available. We're then also going to lift the lid on what potentially may be alternatives to pensions for those that maybe pension saving might not be appropriate anymore. We're going to talk a little bit about financial planning and the importance of that, and then we're going to have a look at risk, and then of course finish with the questions and answers. So Towry, who are we? Well, we've been around for a number of years, and as you can see from the map there, we have offices in locations all around the UK, 18 in total, and we mainly provide advice to individuals looking at retirement planning, investment planning, and a variety of services in order to, well, really ease financial individuals and the problems that they may incur. What Towry have achieved, you can see there the first bullet point. We look after quite a significant amount of money for our clients, but we also put a great deal of store in education, and we're accredited with the Chartered Financial Planner status, which really is a demonstration of our continued appetite to employ and have highly skilled individuals working for us. And this has been reflected and recognised by the fact that we are one of a small number of advisors who are trusted by Camelot to provide advice to their national lottery winners. Beneath you can see some of the recent industry achievements that we have gained. So there are your presenters, myself at the top and my colleague Andy beneath. Our contact details are there, but during the Q&A session there is a slide that will re-put those contact details back up. So you can, of course, ask a question over the coming days once you've had an opportunity to potentially reflect on the content of this presentation. So the main topic is pensions, and as potentially you're aware, the lifetime allowance and the annual allowance are due to be reduced again as of the 6th of April 2014, and this is clearly going to have implications for certain individuals. When it comes to understanding which individuals are going to be affected by this, then we're going to have a look at how you calculate the annual and the lifetime allowances so that people can have an understanding of whether or not they are going to be affected. To try and illustrate that point, we've got some examples of individuals just to show who may be affected, to give you a better understanding of maybe those individuals within your organisations that you might want to approach to flag up that there are some things they need to be aware of. We'll also look at the implications if the lifetime allowance or the annual allowance is exceeded, and what are the charges for going over that, and how are those collected. And then we'll have a look at what can be done. In particular, we'll consider the carry-forward rules and also the latest raft of pension protection. Okay, the annual allowance, you can see here we've just tried to show the history of the annual allowance going back to the 2006-2007 tax year. And you can see that there was a general increase right up to 2010, 2011, and there literally was a cliff edge, a significant reduction from 255,000 down to the allowance that we still have today of 50,000. But of course, we are going to be having a further reduction to 40,000 as of April the 6th, 2014. So you can see that the general direction of travel with this has been one of reducing the potential tax relief that is having to be paid for pension contributions, and of course this is simply increasing the number of individuals that are going to get caught within these changes. And of course the same goes for the lifetime allowance. There was a fairly steady rise from its introduction in 2006-2007 of 1.5 million up to 1.8 million in 2010-2011. This was maintained in the 11-12 tax year, but then we've seen a reduction to the current level of 1.5, and unfortunately there will be a further reduction of 1 to 1.25 as of April the 6th, 2014. So again, a further demonstration really here that pension saving and the implications of going over these allowances is going to catch a wider amount of individuals. And of course it's very important that those who at one point may have thought they would never get caught by this are made aware of it, because there are potentially some of those people who are sleepwalking into an issue, and clearly we would like to be able to educate those people in advance of such an issue becoming a problem. I'm now going to hand over to my colleague Andy, who's going to take you through some of the rest of the presentation, and then I will pick up towards the end with some further thoughts. Andy.
Thank you very much, Toby. Just move on to the, well, I was going to move on to the next slide. Let's try that again. There we go. Get the right one in. Just wanted to take some time here to look at the annual allowance in more detail and really how it's calculated. The first point to be aware of with the annual allowance is that the period it's calculated over is known as a pension input period. So each different pension scheme will have its own pension input period. And all inputs, i.e. contributions or pension accrual, within that period will count towards the annual allowance. And that annual allowance calculation will be tested based on the actual annual allowance that's available in the tax year in which that pension input period finishes. Now, most input periods will run for a 12-month period, and they may just run for a tax year, or they may cross over, obviously, 2 different tax years on that basis. Now, I say most input periods will run for 12 months. In certain circumstances, with certain pension schemes, these input periods can be shortened. But you can't have more than 1 pension input period for any one pension scheme finishing in 1 tax year. So taking that on board, let's have a look at the major types of pension scheme that we'll look at. The defined contribution scheme, otherwise known as money purchase, here it's the total contribution in monetary terms that's made by the member, their employer, or any other third party in that pension input period. So you just add them all together, and that's your total input for the year, and that's then tested against the annual allowance. For a defined benefit arrangement, the value here is based on the increase in the individual's rights during that pension input period. And I'll come back to this calculation later because it's somewhat more complex, and we'll give some examples of how that works. Cash balance plans are pretty much working on the same basis as the defined benefit arrangement. I think the other point to make here is that many of your employees may well have a combination of pension plans, so they may have some defined contribution arrangements, they may have some defined benefit arrangements. And where this happens, each pension plan is valued separately, and then obviously you need to add them all together to get a total input for the year, and that's what's tested against the annual allowance. So let's have a look at some examples of how that might work. So the first example here, we'll look at a defined contribution arrangement, and we've taken 3 salary levels here. As you can see, 150,000, 175,000 and 200,000. We've kept the contribution rate the same for each of these at 20%. That may be coming from the employee, the employer, or anybody else, come to that. And we've looked at a wage inflation rate of 2% per annum. So let's see what this actually gives us. So this shows us that over the 15-year period, the £150,000 earner will not actually breach the annual allowance. They'll just about butt up to it at the end of that 15-year period. The £175,000 earner will have issues in future years if the allowance is not increased. And certainly at the moment, we're obviously seeing a general trend of pushing that allowance down rather than up. So the expectation is that sometime around year 8, that individual would be going in excess of the annual allowance. The £200,000 earner is pretty much has issues straight away. Once they get a pay rise, they will go above that £40,000 allowance. We'll take a look at the tax consequences of exceeding this allowance a little bit later. But let's first just move on to the defined benefit example and look at how that might work. Now, as I mentioned before, the defined benefit calculations are more complex. Within the calculation, there is an allowance made for inflation, and that's based on the Consumer Price Index, CPI. And the figure actually used for that is the September figure in each year. So in this case, we've got an employee here on a salary of £150,000. They've got a 60th scheme. The CPI rate is 2.5%, and they've done 19 years service. Now, what happens is you need to work out the net increase in their pension from one year to the next, i.e. taking away that CPI figure. That net increase is then multiplied by 16 to give the annual allowance figure. So we'll have a look here at what happens if this individual gets a wage increase of 1% a year, 2% a year, and 3% a year. So let's just have a quick look at what that comes to. You see from these figures that the lowest increase, the 1% increase, actually gives a reducing annual allowance sum. So basically what's happening here is that the 1% salary increase is being more than offset by the allowance for the 2.5% inflation rate. So that individual would, over that period of time, if they carried on like that, have no issues regarding the annual allowance. At 2% a year, you'll see that over a period of time, inflation does not completely offset this increase. And here again, somewhere around 8 years from now, that individual would be going in excess of the annual allowance. And at 3%, there is an immediate problem. So that's the annual allowance, and basically how that's all calculated, and hopefully gives you an idea of who in your companies may have issues with this allowance. But let's go on and look at the lifetime allowance. So the lifetime allowance is just the maximum amount you can build up over your lifetime in pensions without being hit with a tax charge. And we'll look at this example here where we have an individual member, a 50-year-old, salary £150,000, and we're looking at two scenarios here, a pension fund of £600,000 and a pension fund of £800,000. So that's what they've built up so far. Same 20% contribution rate, same 2% wage inflation, and what we're allowing for here is a 4% investment growth. So we feel that's a reasonable level to look at. So again here, let's look at how that projects through. And here you'll see that despite both fund values being well below the new £1.25 million limit, they would both breach the annual allowance, the lifetime allowance before their likely retirement date. And I think this is one of the major issues here, that many employees, I would expect, with that sort of amount of money in their pension, let's say a 50-year-old with £600,000 in their pension, may not realise that they have a problem with the lifetime allowance, and may, as Toby said, just to blindly carry on regardless, not realising that they could be left with a tax charge at the end of the period. Now, these employees need to make decisions now. Let's look at also an example of a defined benefit arrangement. So again, similar situation, 50-year-old on £150,000, and in the 60th scheme, 2% wage inflation, and two scenarios here, one with 10 years existing service and the other with 19 years existing service. Now again here, the calculations are more complex than the sort of money purchase type arrangement, and the way the final totting up against the lifetime allowance is done is that the final pension that the individual receives at their retirement date is multiplied by 20 to give the value against the lifetime allowance. Any additional tax-free cash that's paid needs to be added to that total, just as a pound amount. So what we're going to do with this one, we'll assume that no tax-free cash is paid and just look at the income and obviously be multiplying that by 20. And again, we'll just look at the projections on that. So again here, both these situations of a 10-year service and a 19-year service will see these individuals exceeding the lifetime allowance before their likely retirement age. So what are the consequences of exceeding both these allowances? And let's move on just to have a look at that. So, annual allowance first. The objective of the tax charge on the annual allowance is basically to remove any tax relief that's been given on those contributions. So if an individual has made a payment to pensions out of their salary, that will have been taken before any tax has been deducted. So technically they've had tax relief on that money. Now, the tax charge is therefore based on the amount of tax relief that they got. And as tax relief is given at their marginal rate of tax, then the rates are therefore, as you can see on the slide, either obviously 45%, 40% or 20%, depending on the level of tax they were paying. Now, that needs to be declared on their self-assessment tax return. Now, there is an allowance for the scheme to pay the tax if the taxable sum, i.e. the tax charge, is over £2,000. And if the individual requests that the scheme makes that payment, the scheme must make the payment. They will have no choice. But obviously, if the scheme is making the payments, then they will reduce the pension that the employee is going to receive at the end of the day to take account of the tax that's been paid by the scheme. The idea of this is really just stops an individual suddenly having to find a potentially large sum of money out of their own pockets when they might not have it. But obviously, if you're paying into a pension scheme and you're not getting tax relief on those contributions, it may mean, therefore, that the pension is not the best savings vehicle. and that's certainly something that later on Toby will touch on again. As far as the lifetime allowance goes, there's two potential tax charges here, and the tax charge depends on how the excess is taken once you pay the tax. And the charge, well, the test against the lifetime allowance is at the time you take the benefits. And you may, of course, find an employee may not be taking all their pensions in one go. So each time you take some pension money, that will be tested against the lifetime allowance, and you will use up some of the lifetime allowance that you have each time you take money out of the pension. The tax charge starts kicking in once you've taken benefits that then exceed your lifetime allowance. As I say, now it depends on how you finally take that money. If you take it as a lump sum, a cash lump sum, then there is a 55% tax charge on that. So the employee will only get 45% of that excess. If the excess after tax is taken as income, then the tax charge is 25%. Now the reason the tax charge is lower there is because, of course, if you take it as income, there will also be income tax to pay on that income. So, it swings and roundabouts really, and which option would be best for any employee will depend on that individual employee, and was something that would need to be worked out before they finally decided to take the benefits. So as you can see, the tax consequences are quite substantial, and I guess the question is, can these tax charges be mitigated? Well, to an extent, the answer is yes, they can be, and there are certain things that can be done. As far as the annual allowance goes, we have carry forward, and that may be a way of mitigating the tax consequences of exceeding the annual allowance. And as far as the lifetime allowance goes, there are two new forms of protection that are available or going to be available to assist with any lifetime allowance problems that are cropping up. So let's have a look at these different ways of mitigating the tax charges in a little more detail. So carry forward first, and the idea of carry forward is that as it might be given away a little bit in its title, is that you can actually bring forward any unused allowances from the previous 3 tax years. So in the example we've got here, we're looking back over the previous 3 tax years, and we'll see in 2011-12 this employee made a contribution of £10,000 into their pension, and this contribution may have been from them or their employer or from another third party. Doesn't really matter, it's a contribution of £10,000. Obviously at that stage the annual allowance is £50,000, so that leaves £40,000 left over. The following year they made no pension contributions whatsoever. That gives them £50,000 as an unused allowance. And again, 2013-14, £30,000 contribution leaves £20,000 unused. So what we've basically got there is unused allowances from the previous 3 tax years totaling £110,000. Obviously, within the tax year, that employee is going to have a £40,000 allowance. So the maximum contribution that could be made in 2014-15 on that basis would be £150,000. Now, just make the point there that to claim tax relief on a contribution of £150,000, that employee would need to have earned at least £150,000 in the tax year. Let's move on. That's obviously looking at the annual allowance and issues there. Let's move on and look at these pension protections, which may be able to assist with the lifetime allowance issues. So, we have these 2 forms of protection, Fixed Protection 2014, and that is available to anyone who applies for it. Applications must be in by the 5th of April next year. No latecomers, the HMRC will not accept any late applications, and we know this in the past where individuals have tried to put in late applications with previous forms of protection and they have all been refused. The issue with fixed protection is that obviously you will get your current or the current limit maintained, i.e. at £1.5 million. So if you apply for fixed protection, you get your limit of £1.5 million there. Your lifetime allowance will not drop to £1.25 million. However, applying for fixed protection means that you must cease all pension accrual as at the end of this current tax year. So that means no further contributions to any defined contribution arrangement and no further pension accrual within a defined benefit pension. As I say, any accrual or contribution would mean loss of fixed protection. Individual protection is only available to those with pensions valued in excess of £1.25 million on the 5th of April next year. Now, obviously, nobody knows what their pensions are going to be available at that time or the amount it's going to be worth, so you can't actually apply for fixed protection, individual protection at this stage. It again offers an additional lifetime allowance, and the lifetime allowance given with individual protection is going to be based on that pension value at the 5th of April. And basically what you will get is the value of your pension up to a maximum of £1.5 million. And you will have 3 years after the end of this tax year to apply for individual protection. So the cut-off date for that is the 5th of April 2017. And the major difference here between individual protection and fixed protection is that you can continue to accrue pensions. So you won't lose individual protection if you have more pension contributions going into your pension plans. I should also mention that it is possible and allowable to apply for both these forms of protection. If you do that, the Fixed Protection 2014 takes precedence, and that's the one you will have. However, if you then did at some stage later accrue further pension benefits, you would obviously lose the fixed protection and you could fall back on individual protection. So certainly it may be worthwhile for some people to apply for both. There's no cost of applying for these, so it's no real issue in doing so. So who really should consider these forms of protection? So the first point to make on this is that anyone with any previous form of pension protection from the previous changes to the lifetime allowance will be absolutely fine, and in fact they're not allowed to apply for these forms of protection. Obviously they don't need to, but they're not allowed to either. But really fixed protection is for anyone who's expecting to exceed the new allowance, either £1.25 million, without further pension accrual or contribution. So they've built up sufficient in their pensions that if they just leave them, they are likely to exceed that limit. These are especially worth considering if the employer is willing to remunerate these other individuals in different ways. So it may be rather than paying into the pension, they can give them extra salary or some other forms of benefits. Individual protection, as I say, is currently obviously there for those who are going to be over the £1.25 million, and here it's really for those who would still get value from further pension accrual. Now, obviously, they would be paying tax on that accrual, but it may be that they're still getting very good employer contributions, and the employer is unwilling to remunerate them in any other way. So they'd be better off getting some money from the employer and paying tax on it rather than nothing at all. So that's look at another calculation just based on that. So we have here 50-year-old, currently got £1.1 million in their pension. Obviously, at that stage, they've decided to apply for fixed protection. We will assume a 4% growth again, but obviously, as they've applied for fixed protection, they will not be making any further pension contributions. So again, let's have a look at the results of that. So as we can see here, that the difference between the 1.5 million and the 1.25 million, it gives them certainly a much more leeway there. And the big point to make is that applying for that fixed protection will have saved that individual a tax charge of £137,500. So not a small sum. Now, here, obviously, if you are going to cease pension contributions, for many there's likely to be a need to look at other forms of investment. And on that, I'm going to pass you back to Toby, who can cover off some of these points for you.
Thank you very much, Andy, for going through that. Hopefully that's illustrated the situation that the changes with pensions is going to present. So what next? Well, we would certainly want to really explain to clients the importance of financial planning in order that there is really an effective process that's going to be able to identify and prioritise their objectives and really try and get them to understand what it is they are going to need to have accrued in order to make a successful retirement. And potentially, if we've identified that pensions are going to no longer be the platform they can continue to build on, they're going to need to divert that saving appetite elsewhere. And having gone through a financial planning process, you feel far more confident that you can then open the discussion about alternative forms of saving, which in their nature will have degrees of risk and potential attraction to various tax allowances. So we believe that financial planning gives us this platform in order to have those discussions and can hopefully deliver clients successfully into retirement. Pensions clearly have tax advantages, but there are other ways in which you can save that have tax advantages. Tax shouldn't be the be-all and end-all, and often the reason why tax advantages are offered is to encourage investment into certain areas, and that might be because those areas are relatively high risk, potentially new technology, specifically things orientated towards green and social enterprises. And I've just listed here some considerations on a tax-free broadly side. We have ISAs, which a lot of individuals will be familiar with and may already be making use of. There are certain products within the National Savings Stable that offer tax-free returns, albeit some of those are still closed, but that is an area to consider. You can have tax favoured, and this is where you can start to consider things such as venture capital trusts and enterprise investment schemes. You then look at the various tax rules that we've got at the moment. You've got capital gains tax and income tax. Capital gains tax has a top rate of 28%, income tax has a top rate of 45%. You can see that at the moment a favoured way of building up funds of money is to try and explore the capital gains tax regime as opposed to the income tax regime. So looking at structures which favour capital gains tax can be advantageous. And then topical, I know, but offshore provides an opportunity to consider for some individuals, and of course has tax advantages as well. This table is a little bit busy, but it's really just designed to illustrate what alternative investment options offer by way of tax incentives. And certainly you can see with the Venture Capital Trust, the VCT and the EIS, you have quite significant maximum investment amounts, and BPR is business property relief. You have minimum holding periods, so again, there are strings attached to that. If you're going to get tax relief, and you can see the income tax relief is 30% on both the VCT and the EIS, unfortunately there are strings, and you do need to hold these investments for a period of time. And there are a variety of other tax benefits, as you can see with the yeses in the columns beneath that. The tax-efficient investments on the right-hand side, the ISAs and the pensions, well, broadly speaking, for a lot of people, pensions may no longer be a place they can continue to build on for the reasons that Andy went through. ISAs may be an allowance that has already been fully used as well, but again, it does have advantages. But of course, these alternatives do need to be explored in the round of looking at the client's overall situation, and aren't necessarily in themselves the sole answer to accruing savings towards retirement. I mentioned there tax. Of course, tax rules do change, and often as soon as you think you've got an understanding of them, in March the budget comes out and they're changed again. And of course, we're only as good as the current rules, and as they stand, that is our understanding of them and what the benefits are. Risk is an important part to consider, because I mentioned tax relief often applies to investments to incentivize investment in there, and you can often find that you're going into higher risk areas which potentially may be outside of the comfort zone of individuals. So people really do need to understand the risk of what they're investing their money in, rather than being simply seduced by the fact they're getting some income tax relief on day one. But potentially they do form part of a more overall solution to retirement saving. Individuals will also look to accrue money in general investment portfolios, and again, risk is particularly important here. And what is, I think, goes hand in glove with this is financial planning. If you can get an understanding of what a client wants to achieve, where they are now, where they would like to be in a number of years' time, you can do some analysis to show them what level of return they're going to need to get in order to reach their objective. And it may be that that level of return is not in line with the risk that they're prepared to take, and in which case a discussion can be had to try and see, well, is it the fact that they would be prepared to accept more risk, or would that simply be not the case, and in which case it may mean that their retirement plans should be put back several years. But the importance of financial planning allows a much greater awareness of risk and return, and also allows you to give a client an understanding of what can happen in a particularly challenging market, and would they be comfortable if their valuation at the end of a year showed a negative value of, say, 20%. And that really, I think, gives clients a much greater depth of understanding there. Investing within tax wrappers, well, we've looked at pensions, and people clearly accrue money in pensions, but looking at ISAs and certain other tax wrappers, that money has to be invested. So, of course, you're looking at portfolio construction, and how can you do that most robustly? And really there are the three sort of main headings that I'm going to show in the next slide, which is that of the importance of diversification, the importance of looking at different asset classes within that, and with the overall view here and aim of trying to manage volatility. What I've put up in front of you there, a busy slide, I know, but it just tries to show, well, what does diversification look like in practice to us? And the first thing you can see on that wagon wheel is clearly a significant number of different segments, each segment corresponding to a different type of investment. So diversification does need to have an awful lot of different parts to it to ensure that you're getting a robust entry into investments, and also you're trying to there give clients a much smoother ride and iron out the peaks and the troughs. And of course, we're all brutally aware still of what happened in 2008, 2009. Once, of course, you're comfortable with your asset allocation, how much money you should have in equities, property, and so on and so forth, it's important that you then go out and find who are the right people to run that money. And so diversification then goes by not simply trusting all of your decisions to one investment company. It's by having lots of different investment companies, and certainly at Towry, we put a great deal of time and effort into the due diligence of where we actually place our clients' money, and that really is incredibly important for anybody looking to build up a portfolio within their pension, but also outside of their pension, and managing risk. Of course, one of the sort of things that nags away at the real value of our money over time is inflation. And this slide is just simply put up to illustrate, in the 5 years since July 2008, well, £1 is now worth 85p. So, of course, being mindful of what happens to inflation, especially over the longer term, it's very important that clients looking towards their retirement understand the implications that inflation will have on the real purchasing power of their assets. So again, another further demonstration of why looking at how the money is invested and the return that's needed, inflation needs to be a big part of that consideration. So how can we help? Well, we would certainly wish to make aware that we offer financial planning services for directors and senior executives, and we are working in partnership with some very large organisations along the lines of the situation with regards to pensions and what the alternatives should be. I mean, some of these initiatives are sponsored by the company themselves, who are keen to look at that as an extended benefit to their senior executives. So hence the reason why I put the question mark after that. But we would certainly hope that this process will assist in identifying and quantifying who may be affected, and also be able to illustrate to those individuals what their financial objectives are and how we are going to be able to meet those objectives and what that individual is going to need to do in order to meet them. And hopefully this process really supports some of the key HR priorities that you would have, which is sort of employee retention, work-life balance, sort of engagement with the employee, and of course talent management. Benefits to the company, well, I would think most of those would be reasonably understood, and hopefully by being able to offer this type of service to the senior executives, it's showing that you're aware of the concerns they may have. You're putting in place an opportunity for those individuals to have those addressed in a bespoke fashion. The process and what we are trying to offer shouldn't disturb or get in the way of existing employee benefits, and also for individuals who may already have their own financial contacts, it needn't necessarily ride roughshod over that. It can simply be viewed as a complement to it. And the last bullet point, we would hope that any directors and senior executives going through this would really appreciate the company's concern. So my concluding points to this are, hopefully we've illustrated the pension changes are going to need advice. It's a complicated area to understand who's going to be affected. We can only really show a handful of projections without making the presentation too long, but clearly there's an awful lot of moving parts, and some of the questions that have come through are highlighting that. But there are alternatives to pensions, but it's important that people get that advice now. Clearly there's a cliff edge coming on the 6th of April, and for an employee to walk in on the 7th of 8th of April saying they've read something about pension changes, is it going to affect me? Well, it may already be too late, so really early intervention is key here. In order to, I think, perhaps add value with regards to alternatives for pensions, then it clearly is a case that financial planning should be really at the centre of that, to allow a robust conversation to be held about alternatives, risk and tax. But fundamentally, we're here to help. So we've come to the end of the 45 minutes for the presentation. So it's now open to the questions. I will put up the slide which just has both mine and Andy's contact details, so if you want to reflect on what we've discussed and then come back with a question in due course, you can jot our details down there. What I'll do though is we've had some questions in, so Andy, we've had a question in sort of asking about a DB pension scheme that's ceased future accrual several years ago, and how does this affect or count towards the annual allowance?
Well, as far as the annual allowance goes, unless there is any unexpected increase in that pension above the sort of normal inflation increases that you would see within that plan, then it should not count towards any annual allowance. So it's only as such current pension schemes that are being contributed to in one way, shape or form that will count towards any annual allowance calculations.
Thank you, Andy. And I think probably the next question I'm going to ask is a similar question, but to the defined contribution pension, which is, does fund growth count as a contribution? And hopefully one of our illustrations demonstrated that it doesn't. That would be correct,
yes,
Andy.
Absolutely right there, Toby. Yes, I mean, fund growth is not a contribution as such. The issue with fund growth, of course, is that if you get unexpected high fund growth, you can, of course, exceed the lifetime allowance when you really weren't expecting to. I suppose, in the sense, you're paying tax on something that you perhaps weren't expecting to grow that quickly, which is not necessarily such a bad thing. But the issue of really, I say projecting forward growth is obviously very difficult, because I think we'd be the first to admit that nobody knows quite what's going to happen in the future.
No, well, absolutely. I couldn't agree more with that. A couple more questions which I think are very relevant, which is so along the lines of, well, as responsible employers, what should people be doing in light of these changes? I mean, my view on that is, hopefully this presentation has identified a little bit more accurately those who may be affected, but clearly a sort of a much more closer analysis of individual circumstances is the only way to really get to the bottom of that. And then it's a case of an education process to those individuals, a quantification of their particular situation, and then a facilitation of advice. How would they like to address that? How would they like to involve advice, and whether that would be Towry being involved, or whether that is simply working with their existing advisors. Would you elaborate on that any further, Andy?
Well, all I'd say there, Toby, is that it's a question, I suppose, of looking through your total employees and trying to work out who within that might be affected. Now, with the annual allowance, it's not that difficult, because obviously you can make the calculations based on your scheme contributions, and there you would know who's likely to be exceeding the £40,000 allowance. And obviously you're not necessarily going to know if your employees are paying money elsewhere, and that could cause an issue. But I think if you went through your own scheme details and picked out anybody that was either exceeding the £40,000 allowance or potentially going to exceed it with some pay rises over the next few years, I don't think an individual there could be complaining that they're unaware of that. Yeah. The lifetime allowance, what again, as an employer, you're not going to know is what else has your employee got outside of your own plan. And there could be anything from nothing to £1 million sitting in pension somewhere. So I think all you can really do there is look at the values of your own plans for the individual, and then say pick a number over which you think it would be sensible for you to have a conversation with that employee about the lifetime allowance. And as we've shown on some of these illustrations here, that the number probably needs to be perhaps a bit lower than you might think. I'd say you might want to look at maybe £500,000 or so. If their pension was worth something around £500,000 at the moment, it's worth talking to them, because either there may be, obviously in future that may still grow to over the £1.25 million, or someone with £500,000 worth of pension here may well have other pensions elsewhere, which could also be worth a sizable amount of money. So it's worth having the conversation. And I think really as an employer, if you've flagged these things, then you've at least done the minimum that I think any employee would expect. Whether, as you're saying, Toby, whether you want then to assist those employees further with additional financial advice by making that available to them, then that's another consideration.
And I think that's a sort of a good segue into another sort of strand of questions, which have obviously people have been concerned about. Well, don't want to cross the line between offering members sort of information and straying into giving financial advice. And I think certainly my view on that would be that Towry as a company get involved in an awful lot of sort of the education side of these things, and then clearly are positioned well in order to be able to pick up on more bespoke questions from individuals and potentially to sort of take them down an advice process, so to prevent sort of the employer getting into an area where they feel uncomfortable, as they may feel they're getting into the realms of advice. It's partnering with a firm who really would pick up that responsibility.
Yes,
I don't know if you'd...
I would absolutely say, Toby, that's absolutely right. And I mean, I think, obviously we're aware of employers that we've worked with that are doing that. And I mean, that's sort of, I suppose, the next stage beyond what I was talking about before. So, whether the employer would make time available for some employees to have those sort of conversations. And again, they might wish to consider whether they're willing to fund, some of the cost of those conversations. But that's all something, obviously, to be considered in the wider issues of making sure employees feel that they've been looked after, I suppose, by their employer.
I mean, although April the 5th may seem to be a reasonable distance off, of course that will relatively quickly be upon us, and I think perhaps the earlier this sort of education process is looked at, then the more opportunity and the more time is afforded to being able to ensure individuals get the right advice in advance of the cliff edge that's going to come as of the 6th of April 2014.
Yes, I think you're right there, Toby. I think I'd be very cautious about delaying looking at this too much longer. There's a surprising amount of work that needs to be done with an individual when you're looking at this, and a lot of number crunching needs to be done. If they've got other pension schemes other than with your own company, then there's a question of getting all the information on that and revaluing those up to the time they're likely to take those benefits. So it's not a simple job to, a 5-minute job to look at it and say yes or no. So, it's probably going to take potentially, maybe a couple of months at least to look at the information and come up with the right answer. So, let's not leave it till after Christmas, really, because it could be too late.
Yeah, sure. Another question's come through here, a sort of more specific question. If a pot of a pension fund of 1.25 million was accumulated and then £250,000 drawn down, can you then contribute another £250,000 inclusive of growth with full tax relief? And I'm not sure if that question is referring to drawing down the £250,000 from the pension scheme with a view to putting that back in again. But Andy, you'll no doubt sort of be able to talk about it a bit more, but there are rules around sort of recycling things of tax-free cash, etc., which potentially would make that problematic.
Yes, I mean, the first point to make is nothing to say you can't take benefits from a pension and continue contributing to another pension, or technically actually continue to contribute to that pension. However, the HMRC have certain rules around, as Toby mentioned, their recycling of tax-free cash. So obviously, drawing down £250,000 out of the pension, you'd only be getting 25% of that as tax-free cash. The rest would have to be taken as some form of income. But if the tax-free cash was then put back into the pension and there was an intention to do so, HMRC rules may well frown on that, because what you end up doing, of course, you take tax-free cash out of a pension, put that back into the pension as a pension contribution, then potentially you could take 25% of that out as tax-free cash and put it back in again, etc., etc. So you're sort of getting your more than one hit on your tax-free cash, and that's what HMRC are uncomfortable with. What I can do with that question is actually I'll pick it up afterwards and send a link to, I think it was Neil, wasn't it, asked that question, onto the HMRC site, which gives more details about how recycling or how the recycling rules work. So we'll send that out later.
Okay. And another question on a specific area was around the advantages and disadvantages of the use of an accepted life policy for high earners. So I don't know if you want to sort of extend on that point, Andy.
Yes. I mean, I suppose the big benefit on as far as this situation we've got now is concerned is that accepted life policy is not part of a pension scheme, so it's outside the pension. Therefore, for an individual who had to cease pension accrual, they would still be able to maintain this life cover without that being seen as accruing pension. So that's an advantage there. The other advantage, obviously, using an accepted life policy, which is obviously a group type arrangement, is that there are normally sort of free cover levels with those type of plans. So you haven't got all the health issues that might crop up. Some of the problems with accepted life policies are they are more restrictive in the cover that they offer, or less flexible, should we say, in the cover they offer, where everybody has to have the same level of cover, whether it's 2 times salary, 4 times salary, or whatever. So you're either going to be restricted to giving everyone the same, or you're going to need to set up more than one policy to cover all your different employees. And one just thing to mention there is if you've just got sort of like maybe 1 or 2 individuals, you can consider a relevant life plan instead of the accepted policy, which is more of a single life type arrangement, which again is obviously outside of the pension scheme.
Thank you, Andy. A question here just sort of come in, which is really asking about an individual who, not just exceeds the 1.25 million, but is actually in excess of the 1.5 million, and was hoping that the 1.8 million lifetime allowance would remain in place. The question is sort of asking, should they be applying for individual protection, and what would happen to any pension above the 1.5 million? I suppose that's probably an individual who perhaps missed the protection issue the last time round, and so obviously the situation is a little more acute this time. But obviously individual protection would be available, but would only secure a lifetime allowance of 1.5 million. Anything that's already above the 1.5 million, I'm afraid there is little that can be done to protect that. Would that be right, Andy? Yes, that's right. I mean, whereas I'm obviously very wary about not making sure I don't give any advice without all the details, but basically, yes, let's put it this way. If that individual did apply for individual protection, they would be covered at the £1.5 million limit, and obviously could continue to accrue pension benefits as much as they liked after that without losing that protection. However, anything above that £1.5 million is going to be subject to the lifetime allowance charge, and as we covered in the presentation, that's either going to be a 55% tax charge if it's taken as a lump sum payment, or 25% plus obviously the income tax charge on the plan if they take it as income. Yeah, thanks very much for that, Andy. Again, just scrolling down, I think we've time for sort of one more question, and this one's sort of for fixed protection 2014, where you would need to cease accrual. Presumably this can be done by you opting out of the scheme. You don't actually have to leave employment linked to the scheme. No, absolutely right. You can just opt out of the scheme, and obviously you can maintain your employment. Obviously, you're just not accruing further benefits within the pension plan. And I think one point just to add on to that, which we've not covered in this, but is something to consider, is of course the auto-enrolment situation, with many employers now getting involved in that. Of course, if somebody opts out of the scheme, the employer will be required to opt them back in under auto-enrolment arrangements, and it's important that the employee ensures that they
sign an opt-out form again to make sure they are not opted back into the scheme, because if they are opted into the scheme and they accrue further benefits, they will lose the protection.
Yeah, and once lost, it can't be put back in place.
Absolutely right. Yeah.
Yeah.
And HMRC are not very sort of helpful on that sort of front. They can't say,
less than charitable, I think, would be the phrase.
Probably a fair comment.
Yeah. Well, I think that brings us to an end of what we wanted to go through today. I do hope that it made things a little clearer on the pension side for you. Hopefully you've had an opportunity to jot down our details if you want to sort of pick up on a more one-to-one basis after having time to reflect on what was discussed. Clearly we'd be delighted to help in any way we can, and we look forward to being able to answer any more of your questions in due course.